Well, first, don't forget that all those sentiment indicators you're mentioning, like the Business Roundtable's capital spending indicator or the NFIB survey of small business sentiment, they were all at historic highs, and then they sort of leveled off a little bit at historic highs. And so I think that the idea that there's like a turnaround away from growth is just inconsistent with what we see in the data. And as you know, and as you've noticed with the jobs picture as well, everything's very strong. Wage growth is there. Incomes are growing a lot. We're seeing lots of anecdotal evidence of a very, very strong Christmas. We've had, great sales in the fourth quarter. At CEA, our estimate for consumption growth in the fourth quarter is 4%, which is consistent with that strong income growth. So again, all of that stuff suggests that there's momentum going forward. But if you go back for the last 40 years, then you don't get a recession after a 3% quarter. It just doesn't happen. And we're looking at about a 3% quarter and a 3% year. So yes, I absolutely, you're right to point to financial markets and say that there's a lot of turmoil. I think that some of that is related to the global slowdown, and some of that might be related to this apparent misunderstanding about how to interpret the yield curve right now.
So the S&P 500 is down 16% from its high in 3 months because people aren't really sure if the yield curve is giving them a bad signal, or is it perhaps
no? There's going to be a profit
signal.
You pointed that there's definitely a profit signal. I think that people are, have been whipped into a frenzy about the recession probability being a lot higher because of this faulty yield curve analysis, and then so the true fundamentals moving markets. But I think that if there were signs that if the jobs number was negative, if retail sales were declining, if we were looking at GDP growth in the fourth quarter of 1.6%, which is what we got for the whole year in 2016, then there'd be a lot more reason to be nervous. And so I think that right now, the Fed just lifted rates because they believe, like we do, that the economy's strong, that inflation pressures are low. They've signaled a couple of more things that they're going to do next year, but that's based on the fact that they believe the economy's strong. And so to flip from that to, oh my gosh, we're going to have a recession, that the world's falling apart, I think is really to jump too far.
Kevin, the president wants to see the stock market go up, clearly. Why now is he threatening the government shutdown 24 hours to go here and not going to sign this Senate short-term spending bill? It didn't help market sentiment that was already fretting the Fed.
The president has a very small ask that he's had really since he arrived, that Congress focus, like voters want him to do on border security. And I think that he's absolutely adamant that that's going to happen. We've seen a lot of down-to-the-wire negotiations in my lifetime here. I've been in Washington for 30 years, and it looks like we're about to have another one. But he's got a very, very firm position. And I think that, he's right now engaged in ongoing negotiations to achieve his objectives.
Do you think there will be any economic consequences if the government does shut down?
I think that if the government were to shut down for a really long period, that there are estimates that can have a negative impact on the jobs numbers in the short term. But think about all of the turmoil we've had over government shutdowns over the years. Looking back on it, it seems like we tended to overreact, and economically, it's not something that really has a big long-run effect. But for sure, if we had a long government shutdown, then it might show up in the jobs report and so on.